Well, good morning to everybody, and thank you for joining us. We're really excited to do this call and to have a dialogue with everybody. And we've been convicted over the years that we've kept an overly low profile in my company and what we do and what we think. And as most of you all who know me well on the call realize, I'm not shy and I do like to talk. So we decided to up the profile just a little bit and have more of a frequent dialogue with friends and family and clients and people that we enjoy being around and talking to. And I'm sure many of you are pretty sick of Zoom and pretty sick of these dynamics we've been in the last 2 months. And we've spared you the Zoom element today. Since I have a radio face and a current Pat Riley hairdo because I can't go to the barber shop, we decided we'd just do an audio call today instead of a video call as well. So I just want to start the call by saying that our prayers and thoughts go out to every family and every individual that's been affected by this virus, either contracting it himself or herself or a family member getting it, and for all the people who are out of work or whose businesses are suffering or who've really been handed a setback by all this, and that's a lot of Americans. I mean, this is a pretty extraordinary time we're in right now, and I haven't been affected within my family, and I've only got 2 friends in their 70s, one here in this country and one overseas, that contracted the virus and fought it brilliantly and nobly for an extended period of time and finally beat it, did not succumb to it. So I'm very grateful for that, and I'm very grateful that my youngest child, Elizabeth, who was serving as a missionary in Italy for Campus Crusade for Christ, got out of that country one day before they shut it down. So this is all affecting us in one way or another, and our thoughts and prayers go out to everybody affected. So this morning, I think only career politicians like to hear themselves talk on and on and on and on. My wife Gretchen and I recently went to an event where a career politician who was not the featured speaker at the event and who will go unnamed because I don't want to be overly negative, talked for about 45 minutes, and it just was like Chinese water torture. So I am not going to talk for 45 minutes this morning. It's 11:05, and I expect I'll be done with comments by 11:15. And then we'll open it up for questions because I think it's much more interesting to hear from you all and hear what's on your mind and what you want to address. So that's kind of the format today. And I've got 3 topics I want to address before I turn it over to questions, and that's the economy generally and something that's related to it but separate and distinct, which is the global investment markets, both stocks and bonds. And then a subset of those 2 factors, the economy and the markets, and that's our state of Texas and where we're going over the next 5 to 10 years with Texas. So that's what we're going to talk about this morning, and I'm going to launch into it, and then we'll open it up for questions once I finish these brief remarks. So on the economy, what we're undergoing is unprecedented. And I say it's unprecedented because if you go back to the Spanish pandemic of 1918, and many of you have probably read up on that in the past couple of weeks to kind of get some analysis of what we're going through right now, the global economy was not integrated whatsoever back then. I mean, you had some trade through shipping and over land from Europe and Asia and all that, but the global economy is completely integrated today. So what we're going through and the shutdown we've had to endure with all the travel that people make has never happened before. This is historic, and we're going to be talking about this strange, unusual, and kind of sad time and analyzing it for generations to come. I've heard several people say that this will be over in a couple of years and people will forget about it. I don't believe that. I think that World War I superseded the Spanish pandemic, and that's why people don't remember it as well and don't talk about it as much. But we've got no competing influence for our attention right now, and this is such a weird time that I think that we'll be analyzing how to avoid a similar occurrence for many years to come. Unemployment levels, as we all know, are threatening Great Depression levels. We've got 26 million people unemployed, and that's going to go significantly higher, and that's not going to reverse course for at least several more months, I would think. We've got a ways to go on that. The national debt is breaking all records. It's approaching post-World War II levels as a percentage of GDP. It's going to go well over 100%, and it's currently projected to be around $25 trillion, trillion with a T, and $4 trillion this year alone, which if you talk about when George W. Bush was president, the entire federal debt, was $4 trillion. So that's that's frightening for anybody. Our Leviathan federal government is just getting bigger and bigger and bigger. Some of you may think that's a good thing. I certainly do not. Some industries will not be the same for a long time, if ever. You talk about retail, travel, leisure, restaurants. This is going to change the way we view all those industries and how we use all of them and how frequently we use all of them. The strong companies are going to get stronger within this economy. Low-debt companies that have not over-leveraged themselves, and technology companies in the cloud and over the internet and things like that, they can actually increase their share of the economy through this, whereas others that are much more reliant on in-person business and communications are going to suffer. The weak are going to get weaker. Upstream oil and gas is going to be bankrupted in large part. Oil and gas services companies, and I would say private equity companies that rely on a heavy amount of leverage through LBOs and things of that sort. The leverage is not a good thing right now, even with interest rates so low, because you've got to have revenues and earnings to be able to pay back your debt, and a lot of companies don't have any. Look for a wide U or a Nike swoosh on the recovery. Some industries may make a V-shaped recovery, but not many. It's going to take a while to come back from this after all it's like we've put our economy and our country in a coma. And yes, we're going to wake it up at some point, but you don't just immediately start running the 100 meters in 10.1 seconds after you come back from a coma. Strong states, and I would say Texas, Florida, and mostly red states, you don't want to be overly political about it, but it is mostly red states, will get stronger on the aftermath of this. In weak states, which are primarily blue states with huge deficits, pension liabilities, and higher taxes, will get weaker. And by that I mean New York, Illinois, and the Northeast generally. I would just emphasize this morning that patience is the key to everything. This will be a long, hard slog to recovery for the economy. We're all going to have to learn patience, and we're all going to have to learn with dealing with tragedy or setbacks or boredom for a lot of us. A lot of us are just bored because we've been just sitting around the house for a long period of time, or sneaking down to the office and breaking the rules a little bit, like I've been doing a bit of. So let me transition to markets now, because markets are a separate and distinct topic from the economy, although they're obviously interrelated. This is not 2007 to 2009. In that era, the Fed took almost a year to take decisive monetary policy action, and Treasury and the Congress took even longer before TARP and the stimulus package that they brought forth. This time, the Fed, the Treasury, and the Congress, learning from the past, learning from that experience in particular, took decisive action immediately within a matter of weeks. It was historic, it was overwhelming, and it was decisive. You have to give an A+ to the Fed and the Treasury. I'd give a B to Congress because they acted more slowly and they acted more politically. But they all did their job. And they've given us a tremendous amount of financial support for our country and our economy, and they're to be saluted for that. So will we retest the lows or breach the lows that we saw in March on the stock market? I want to talk about the stock market more than the bond market, really. A week ago, I said 60-40 we would. But today, I'd give it 50-50. The markets are just acting so strongly, and it's funny that the decline in February and March was historical in pace and size. We went down 35% in about a month, and that's never happened before, not even in the Depression. But the rally's been almost even more stunning. I mean, we've now come back more than 30%, also within a month, and that's just so quick to come all the way back with all this adversity we're facing as a country and as an economy. So I'd only give it about a 50-50 chance that we retest the lows of March at around 2,200 on the S&P or breach them. But it's still a likely possibility. It's still got a good chance of happening. Fed action and ample liquidity are cocooning our stock market so far from the devastation we're all seeing on Main Street. It's almost like it's two chapters in the same novel, and they're diametrically opposed to each other. So markets in their action, as we've all seen, are already anticipating a 2021 recovery, and the markets are pricing that accordingly. So will we hold on to these gains or stay stable until 2021, which is a long way away right now? Maybe, maybe not. I want to give you all some factual data because that's important to turn to facts. If 2008 to 2009 earnings and multiples repeat themselves, markets could dive 40 to 50% again, revisiting 1,400 to 1,500 on the S&P. In 2008, S&P 500 earnings went from $88 a share to $44 a share. They were cut in half. If earnings fall 50% this time and the markets assign a 15 times earnings multiple to those trough earnings, that gives you around 1,400 on the S&P roughly. And that's a far cry from where we are today. Today at 2,900 on the S&P, we're trading at around 18 times last year's earnings and 18 times what were projected for this year's earnings until this happened. And on the kind of earnings we're going to get this year, we're probably well over 20 times earnings. So the markets are basically saying we really don't care because we don't care what earnings are this year. We're looking forward to next year. And with interest rates near zero, we'll pay almost anything for stock market earnings, which doesn't strike anyone as super rational, but that's the way the markets behave when they get Fed action of this magnitude. I would say that where we end up in the market, whether we've already bottomed and we're just going to go up from here or whether we crash again, is going to depend on how far down earnings go and how traumatic investors take that once that information is received, how quickly and how thoroughly we contain the Wuhan bug, and that's very uncertain at this point, and then the speed and magnitude of the recovery once we get a recovery. I would highly advise anyone to not get 100% out of the market and attempt to time the market. That's just almost impossible, and it's usually futile. I think that instead, investors should assess their current allocations to stocks and adjust as needed. All investors should keep some dry powder and add to stocks if we get additional excessive weakness going forward. Here at my firm, what we did, which is proving to be not a fully accurate response so far, is we bought stocks about 4 times in March. We actually bought the day the market bottomed when it was around 2,200 on the S&P and a little below that during the day. But we haven't bought since. We've just been kind of watching. The pace of this rally has taken me by surprise, just like everybody else. Our plan is to start buying again if we see excessive sell-offs in the next month, 2 months, 3 months, or into the fall. But we're having a bit of an internal debate within our firm right now because it's unsettling to see. It's good. I mean, it's fun to see the market go up this significantly, but it's a bit unsettling because the facts and the data and the substance don't seem to support that. So we're scratching our heads a bit and having a bit of an internal debate on how to assess that. So we would get overweight stocks if we went significantly below those March lows, but whether that's going to happen again is, as we've talked about, highly uncertain. I would say, though, that generally, whether it's your family, whether it's your finances, whether it's your investments, that patience is your friend right now, and patience is key. That it's going to take us a long time as a country to get through this, and there's no reason to be overly aggressive or overly bold right now. It's not a time to be a hero and to get over-leveraged or overexposed. It's a time to be pragmatic and prudent. I want to talk about the long-term nature of stocks, though, which is important to remember at times like this. Black Monday was a day in October in 1987 where the stock market went down 22.7% in one day. If you were 100% invested in the market that day, if you take it to today, which is about 32 and a half years from then, you made 10 times on your money. But if you were 0% invested at the beginning of that day and then you got 100% invested the next day, you made 12 times on your money. So you had an unbelievably strong outcome either way. So I think it's really important to remember that when it comes to investing in stocks, that time is your friend. But those who don't have 32 and a half years to work with, or 20 or 10, should be less invested in the market and more defensive, whether that's 20% in stocks or 50% in stocks or some other number. You got to determine for yourself. How well do you sleep at night? How well do you handle volatility? Because stocks always bring volatility, but you need some kind of exposure to public stocks and not just private investments, because with public stocks you have liquidity and you have your best chance of making a decent return over time. So I would really urge everyone to not get completely out of the market, to have some kind of exposure to the market. I would also urge consideration of a barbell approach to investing right now. Mega cap stocks with ironclad balance sheets and competitive advantages. Google gave a good illustration of that with positive earnings last night, and the stock's up 8% today. And out-of-favor industries with bright futures. So industries that are not doing so well right now but have rock-solid balance sheets will make it to the other side, and we'll have probably an even more explosive rise once this thing is over. Avoid highly levered investments in out-of-favor industries, it's shaky whether they're going to make it or not. You don't want to be a gambler or a skydiver right now. It just doesn't make sense. I want to talk about oil and gas because a lot of people ahead of this call ask questions about oil and gas. It's counterintuitive, but it's probable that this historic crash in oil, which is greater than the 1920s when the giant East Texas oil field was found and drove oil down to pennies on the dollar, or even the 19th century when John D. Rockefeller took prices up and down to try to bankrupt as many competitors as possible, and there was a huge amount of volatility in the market. This is the worst crash ever. And the ironic thing is, if you go 2, 3, 4, 5 years out, we're probably going to see a historic supply deficit, whereas right now we've got an overabundance of supply and a lack of demand. I would say in that time frame, 2, 3, 4, 5 years out, oil is likely to breach $60 to the upside in that time frame and may retest 100. And if you think I'm crazy to say that, let's discuss it again in 4 years. You basically have an annual depletion on oil with if you don't do any new drilling of 5 to 7 million barrels a day, roughly. And large CapEx projects, whether it's offshore oil and gas drilling or big projects in dangerous parts of the world, have basically disappeared the last 5 years, and they're not going to come back anytime soon. And the U.S. oil and gas shale play in particular is probably going to go down 3 to 5 million barrels a day over the next year or two. Spare capacity for OPEC and Russia is probably around in the 2 million barrel a day range, although they brag about having more, they probably don't. And so you're going to have a big deficit in supply necessary if we get anywhere close to the 100 million barrels a day of demand that we saw before all this happened. Natural gas may come back even sooner, even next winter. Natural gas rigs have already been cut in half in terms of the ones that are active, and ancillary gas from oil wells, mainly in the Permian Basin and the Delaware Basin in West Texas, will all but disappear. We may see $3 natural gas by next winter if we get a cold winter. I would add to this from an economic standpoint and from a trade standpoint, relations with China will not be the same until communism is replaced by democracy or a semblance thereof, if that ever happens. The Chinese mask is off, and it has been revealed as an enemy of the global world order, at least the Chinese Communist government, to distinguish between the leadership and the actual people in the country itself. Antagonism towards China across the globe is an inevitable result when this crisis is over. America has a historic opportunity to make common cause with India and rebuild our relationships with Western Europe and to a lesser degree Eastern Europe, because we haven't gotten as crossways with Eastern Europe as we have with Western, to build a constructive alliance with responsible global actors to offset the menace of China, Russia, and Iran. Will we do that? Well, that's yet to be seen. The current administration's track record in building bridges with Europe is mixed at best, so we'll have to keep an eye on that. And keep an eye as well on instability in the Middle East, Russia, China, and Latin America. This level of disruption caused by this virus threatens all fiscally challenged and totalitarian states. So I'm 6 minutes past where I said I would stop, so I'll turn to Texas briefly, and then I'll open it up for questions. Unlike 2007 to 2009, Texas will not outperform the rest of the country due to the depression in the oil and gas industry and the counterintuitive struggles we're facing in the healthcare industry here in our state. Most people don't realize that Texas has one of the largest healthcare sectors in the entire country, and counterintuitively, because of this virus, people aren't going to the doctor, they're not going to the dentist, they're not going to the hospital if they have something come up, and that's driving revenues for our healthcare practitioners and providers way, way down and threatening bankruptcy for them. However, having said all that, our state doesn't face the pension and budget deficits faced by so many other states. We've got $8.5 billion in our state rainy day fund. Our state pensions are much stronger than, say, Illinois or New York, and politicians are already discussing across the board 5% budget cuts, which is prudent. Creative usage of our rainy day fund to buttress the private sector during this historic period of time. Businesses that otherwise would be healthy and should survive must be planned for right now before the next legislative session in 9 months. Also, due to the pro-business climate of our state, reasonable regulations and low taxes, we're so well positioned to gain in strength upon the eventual recovery from this virus. We'll probably add more and more citizens, more and more prosperity once we get on the flip side of this if we handle it gracefully and artfully, which we probably will. Texas policymakers must maintain our pro-business climate, culture, and government while planning for the huge population gains we're going to see in the next half century. Most demographers, and probably a lot of y'all aren't aware of this, but most demographers think we're going to be somewhere between 50 and 60 million people in Texas within the next half century. And if you think about that, it's just daunting. The infrastructure demands, whether it's roads, whether it's water, whether it's energy, whether it's healthcare, it's going to require so much advanced planning and spending, and it's going to really strain our ability to stay fiscally prudent and a low tax, low regulatory state. It's going to require a lot of focus. We also need, whether it's primary, secondary, or university level education, to maintain our fine educational system. We need to remain either number one or in the top 5 of large states in terms of our elementary school children and our high school age children. And we need to take our university system to number 1 in the world for public universities, and we're nowhere near that right now. So we're going to have a lot of work to do over the next 20, 30 years to get there. So with foresight and wisdom, we Texans are going to exit this pandemic stronger than before, but underinvestment or overly ideological public policy will restrain our growth and strain public services. We need bold policy making and fiscal prudence, both, in terms of getting to where we need to get over the next 50 years. And right now is the time to be planning ahead. And I would salute my friend Tom Luce, who's overseeing a project called the Texas 2036 Project to try to do just that, to plan for the future. And we need our elected officials and our private sector leaders to pay attention to that and to really focus on advanced planning and not live in the day, because our future is going to be full of challenges with how many people are going to be moving here and the expectation that public safety and public services and our economy and our business climate will all be maintained or even enhanced and improved. So with that, I'm going to stop my formal comments, and hopefully some of you all who sent in your questions ahead of this call that I answered them during my remarks. I tried to do that, but I'd open it up for additional questions or clarifying questions for those of you all who don't think I did answer your question well enough. So, Brandon, I turn it back to you for questions.
Great. Thank you, George, and thanks for the insight so far. So, folks on the line, we are going to go ahead and transition to the Q&A portion of the call. You will be prompted to hit *6 on your phone if you have a question. We're going to go ahead and activate that for questions to be submitted, and then I'll ask a few questions of George that were submitted in advance via our web form. So at this time, we're going to activate the Q&A portion of the call. Great. Well, again, if you have a question, please press *6 on your phone. And I'm going to go ahead and ask George a couple of questions that were submitted via the web form while folks can activate themselves into the questioning queue. So, George, our first question is from Reka from the Center for European Policy. His question is there a special potential for the U.S.-Europe relations that you can see in handling the economic impacts of this crisis?
I think that the last several years we've really fallen down in terms of our relations with Germany and France and to a lesser degree Great Britain. It's been troubling to watch, and perhaps there's an opportunity through coordination and cooperation on this COVID nightmare to rebuild some of the trust and goodwill with Western Europe. With Eastern Europe, I don't think there's been much of a fall off, but I would just say that Europe, because of the demographic challenges and because of the economic stagnation, and now with the threat from China and the export of a recession and maybe a depression from China through this virus, that it really behooves Europe even more than the U.S., but the U.S. as well, to really take a hard look at our relationship and to make it stronger and rebuild it and to find common cause in so many of the challenges we're faced with in the world today, whether it's healthcare related through the virus or anything else, or the aging of our population, or economic growth, which is obviously severely challenged by this. So my hope would be that would take place, but that's yet to be seen. And I think that Mike Pompeo and his team at State and some of the other foreign policy makers within the administration need to take a hard look at that, because they haven't exactly been good stewards of that over the last 3 years.
Great. Thanks. We do have a few folks in the queue, so I'm just going to ask one more question from the web form that was submitted. And it was a common one, a common theme that we saw with the questions. What impact will the COVID-19 crisis have on the increasing amount of debt, and how do we get that under control?
Yeah, well, we're not going to get it under control is the short answer. And if you're not worried about this for your children and for your grandchildren, then I don't think you've really thought about it very much, because it's horrifying. I mean, we're going to be at $25 trillion in national debt this year, and we have a huge imbalance in all the entitlements, Medicare, Medicaid, Social Security. And if interest rates on Treasury securities ever got back to the 4, 5, or 6% level, just our interest on the federal debt would overwhelm the annual federal budget. I mean, we'd probably be spending more than half of our money just on interest payments on the debt. So we're in the soup, and you're going to have to raise the revenue to service the debt and close the gap on the deficit. The deficit this year alone is going to be $4 trillion. And obviously we got to get through this virus before we can worry about this. But if you think about the rate of growth we're going to have coming out of this crisis, it's going to be stultified by all this debt and all the interest on this debt. And the government it's going to be really hard, especially if a Democrat's elected president in 2020, to not see significantly higher taxes, which will reduce our take-home income and reduce our ability to live the lives we want to lead and everything else. So I hate to be grim, but that's one of the most grim subjects there is out there. And hopefully we'll see some responsible leadership among our politicians, but I'm not going to hold my breath waiting for that. And we've got to see some entitlement reform. Because if we don't get entitlement reform, we will either see a soft default on our debt by an ever-increasing lack of purchasing power on the dollar, or we'll see a hard default at some point. And our children and grandchildren don't deserve that. So that's something to really talk. Anybody who knows politicians, that's something you should really bring up over and over again, because this creates a sense of urgency that hadn't been there yet. In terms of dealing with this, and whether we embrace that urgency and actually do something about it, or kick the can down the road even further, I'd bet on the latter. But it's really time to have a frank conversation about this, because it's a crisis. It's a bigger crisis than the bug.
Thanks, George. Just as a reminder to folks on the call, if you do have a question for George, please press *6. So we're going to go to our first caller, and it's Leslie Fitzpatrick. So we're going to ask Leslie to join us on the call. And Leslie, go ahead and ask your question.
Thank you, Randon. Thank you, George. So my biggest concern with all of this, and you've mentioned it a little bit, is our relations with the other countries around the world. And as you know, President Trump is withholding money from the World Health Organization. I saw an article yesterday that Australia wants to look into China's handling of this virus, and the Chinese government's already threatening them that they'll not do business or encourage their citizens to travel. My concern is how can we really get down to the bottom of this and, as a country and a world, hold China responsible and be able to move forward?
That's a great question. It's one of the most important, and thanks for being on the call, Leslie. I appreciate it. Number one, we've already seen over an extended period of time, anyone who's been paying attention to the Chinese government, I think we need to focus on the government, because they're not necessarily representative of the Chinese people in the aggregate, but they've been dishonest and misleading ever since they've been in power. So that goes back to 1947. And if you talk about the last 30 years when they've really embraced capitalism, although not democracy, and have really grown their economy, that dishonesty and the embrace of stealing technology from our country and other countries has just accelerated over and over and over again. And I think this virus, with the death that they've exported through covering it up for a month and a half, and the economic pain they've exported through this, it's going to change their relationship with every country in the world. And you already hear Great Britain saying that they're going to reevaluate using Huawei, the Chinese internet infrastructure 5G company in terms of Britain's 5G infrastructure, and you're going to have a lot of other countries reassess that. And obviously, once we get through this, our relationship with China will be dramatically reassessed. And I'm not optimistic with that. I think that's going to hurt global growth and global trade, because I think a lot of countries are going to change the way they relate to China. I think supply chains will be upended to some degree, not completely. Some will stay with China, but a lot will move their supply chains. And I really don't agree with everything the current administration has done related to the virus. I think that we waited way too long before we took extreme measures, and I think some of these press conferences have gotten a little out of control and unwound lately. But I would compliment the administration for shutting down travel to China initially, and also for pulling funding to the WHO. The bias of the WHO, for anybody looking at this objectively, has been really, really clear. They accepted at face value that you could not have human-to-human transmission of the virus when China lied and said that was the case. And they completely ignored Taiwan's requests for information related to the virus early on, because China instructed them not to interact with Taiwan. And for us to be providing the lion's share of the funding to the WHO, and for China to be controlling it with about 1/10 of the funding that we've been providing, is just outrageous and absurd. So this is a real problem. And, you know, you would love to see a productive, friendly relationship between the People's Republic of China and our country, because it would be good for global peace, not to steal a beauty pageant line about world peace, but it would be great for world peace. It would be great for stability, and it would be great for economic growth. But I think the next 5 years, we're not going to see that. I think we're going to see a whole lot of unwinding of the tentative relationship we've had. And I apologize for the long answer, but it's a really big subject, and it's not conducive to quick answers. And I know our policymakers in D.C. and around the country, even down to the state level or the local level, are taking a hard look at this, because it's going to change dramatically in the coming years. Next question, please.
Great. Thanks, George. Next, we're going to go to Richard Pratty, and Richard should be joining us on the line. Richard, do you want to go ahead with your question?
Sure. Thanks very much, George. Thanks for doing this and for hosting this call. I found your comments on energy particularly interesting, and there's a lot of people who've been, pontificating on energy, and obviously a lot of people think, oh well, it must be over because we're moving to alternative energy, and this is just sort of the beginning. And if your view is right and energy's kind of bottomed and it's going to head upwards for the next couple of years, it sounds like it's going to be a pretty massive cycle. I don't want to. From what you're saying, I'm just wondering how you're intending to play that energy cycle, and if any of these, macro issues that you're looking at with debt and interest rates and anything like that are going to impact your decision as to where you would deploy capital. And I got one follow-up if we have time, if you want to address that, please.
Thanks, Richard. Always good to have a Floridian on the call, especially a Floridian who's a native Texan. So we're glad you stepped up to the call. So energy is incredibly complex and difficult to navigate right now, and it's interesting because energy is at an all-time low as a percentage of the S&P 500 index it represents. At the height in the early 80s, late 70s, it was more around 15%. Today it's 2.7%. It's fallen almost 2 percentage points below utilities in terms of the weighting it has, although as a factor on the economy, it's obviously much, much greater in significance. And in the near term, it's a horror story, whether it's upstream oil companies, upstream gas companies, integrated companies, even a few weak midstream and downstream companies. You're going to see a whole lot of bankruptcies. You're going to see a whole lot of job losses, hundreds and hundreds of thousands of job losses. And you're going to see a ton of supply come off the market because the demand has been cut so severely. I think the key is to see whether demand comes back to the 100 million a barrel a day oil level or higher, or whether it comes even close to that. If it doesn't get over 90 million barrels a day, we're still going to have a massive supply problem. But probably when we get to the flip side of this, whether that's in 3 months or a year and 3 months, demand's going to roar back and probably get close to 100 billion barrels or more a day. Natural gas is not going to take that extreme a hit. It mainly is used for heating and electricity and some other causes, and obviously is not affected by airline travel or cars or anything like that. The dramatic conversion to renewables that we've been hearing about for many years now, in which progressives on the environment and on energy have been clamoring for years, saying leave all the fossil fuels in the ground and don't use fossil fuels, and calling for a ban on fracking. Their day is yet to come, because as long as energy stays this cheap, there's really no big incentive to move over to clean technology and green fuels and get away from fossil fuels. You're going to see a whole lot of countries overseas, and this has already been taking place, double down on natural gas as an energy source. You've seen a lot of coal plants being shifted over to natural gas, and that's accelerated with natural gas being below $2 a foot as it is right now. And even if natural gas gets up around $3 a foot and oil goes back over $60 a barrel, those are really not excessive prices compared to what we had even 12, 13 years ago when oil and gas were both significantly higher. Economies can function very well on those kind of prices. And like I said, I would expect within 3, 4, 5 years, you may see $100 oil, you're definitely going to see $60 oil, and you're going to see $3 or more gas. And that's good for America. I think one thing that people have missed, because it's ironic, Texas gave more money to Donald Trump than any other state in 2016. And most people aren't aware of this, but he's been kind of an adversary to the oil and gas industry. He's constantly jawboning for lower oil prices because, most consumers want cheap gas around the country, and it's a political winner for most of the country, and he's succeeded beyond his wildest dreams at this. He's a New Yorker who's kind of stuck in the 70s when New York almost went bankrupt and when OPEC basically sent oil prices sky high by their post-Yom Kippur War protest of embargo against the U.S. and other Western countries. And the reality is that our country is better off with above-average oil and gas prices than the contrary. We really need $65 oil to support the shale industry and the fracking industry, and we need around $2.50, $2.75 gas for that industry to remain viable. And we now have roughly, by most estimates, 12 to 14 million American jobs dependent directly or indirectly on the oil and gas industry, and hundreds and hundreds of billions of dollars of capital invested in the industry. And these kind of prices on fossil fuels is terrible for the country. And that's got to change in time, and I think it will change in time. But in the near term, there's going to be a whole lot of pain. And we in Texas are going to feel it more than anybody else. There's going to be horrible job losses and cutbacks, and we're just going to have to weather the storm. And, I would argue that we Americans in the last 50 or so years, especially post-Cold War, have gotten really soft and have gotten used to prosperity just being a norm. And the reality is, we have rough patches like this. And I think that's one reason we hadn't heard as much about the Spanish pandemic, is because back then people expected bad things to happen, and they learned how to weather them. Whether it's World War I, World War II, the Depression, you go on and on. We haven't really had that many difficult things to surmount. And I think this is a wake-up call for America that we're going to need to weather these hard times and acquire some thicker skin, and when we get to the other side, we'll appreciate it all that much more. So thanks, Richard. Next question, Rhiannon. Or you had a follow-up, excuse me.
Yeah, if you don't mind, I'm just curious with your thoughts on, the dollar and the, potential issues that we've got with the skyrocketing debt and deficits. Are you looking at, emerging markets or different economies to invest in? Are you, are you buying gold? What do you think is the best, tactical and strategic way to respond to some of the circumstances that we're currently faced with, given coronavirus and governments doing some pretty crazy stuff?
Yeah, and I'll answer this quickly so we can get to other questions. But we've been interested in emerging markets for 2 years now, and so far we've been wrong. They really haven't performed that well. If you look at the last week or two in this rally, emerging markets and small cap stocks are starting to outperform the big cap stocks. But whether that's a sustainable trend or a blip, we're yet to be seen on that. And I've been thinking the dollar was going to weaken against other currencies for the same period of time, around 2 years, and it just hasn't. And we're the strongest house in a really bad neighborhood right now, and people flock to treasuries and they flock to the dollar. And whether that changes, I don't know. I think it would be good for the country and good for the world if the dollar were to weaken, though, and I hope it happens eventually. I don't have an opinion on gold. I've never understood gold, and I don't understand how you value it, and it's acting very strongly now, and a lot of people are super bullish on it, and that probably will continue for a time, but I don't know how long. So let's go to the next question, Randon.
Great. And this will be our final question of the call, George, and this call comes from Gina Gregory. So we're going to add Gina to the call here. Gina, would you like to go ahead and ask your question?
Thank you, Randon, and thank you, George, for your time today. George, I think you kind of hit on it, that we've been living in this land of prosperity, but I'm curious, as we're hearing a lot of conversation about budget cuts for education, both federal and I'm in the state of Texas. So you touched on it just a little bit, but I'd like to hear some of your thoughts, because we're also dealing with children who have been out of classrooms for 5 months, and it's going to be a tough road ahead of us. So,
gosh, that's such an important issue and question, so I really appreciate you bringing it up. And it's too big a subject for me to cover effectively today, but I'll do my best. I'm really offended, frankly, by the University of Texas and Texas A&M being consistently ranked 8, 9, 10, 11, 12, 13, somewhere in that range in terms of the finest public universities in the country, and even lower on a global basis. I think that's absurd. The University of Texas investment management company, UTIMCO, is sitting on $55 billion of endowment. And until this shale disaster hit, was getting over $1 billion a year just in income from the land they hold in West Texas that has significant oil reserves, over and above their returns on their $55 billion investment portfolio. It is absolutely a travesty that our public universities in Texas are ranked behind Michigan, California, Virginia, sometimes even Wisconsin and some other states like that. It's a joke. And I'm offended as well that our policymakers and appointed officials have not made this a priority at making the University of Texas and Texas A&M 1 and 2, or at a minimum in the top 5 public universities in the world. And that's got to change in the next 20 years. And I'm frankly disgusted that our policymakers haven't made this a priority. And in terms of primary and secondary education, I think the first thing that's important to point out is that there's no statistical correlation between the amount of money spent on education and the results you get in terms of how well kids are educated and how they score on tests and things of that sort. Having said that, if you're as underspent on education as we've been in the past, usually in the bottom 10 states in terms of per capita spending on education, there's a good argument to be made we need to do more. But that's within the context of a state budget that has limitations. We've always prioritized in Texas. We have to constitutionally be revenue neutral. We can't do any deficit spending, number one. Number two, Medicaid is out of control in terms of the amount it grows every year and is going to consume the entire state budget in terms of how much it's drawing from tax revenue unless we get a grip on it. So we've got to get a grip on Medicaid spending, and I think the push to try to get a block grant from the federal government and we select how we spend it from a Medicaid perspective makes a lot of sense. But also, we've been doing the Robin Hood financing of state education in our public schools for many, many decades now. because we're a property tax system and not an income tax system in terms of how we finance our state government. And it's very inefficient and relates in basically produces a whole lot of negative outcomes around the state because of taking from Peter to pay Paul and all those kind of things. I think that at the end of the day that it's a political hot potato, and politicians tend to pass the buck on it and give a lot of platitudes and nice words and really not do a whole lot to buttress up our public school system. But the reality is, unlike California, which had a top 5 public school system 30, 40 years ago, and now it's bottom 10 in terms of their outcomes out there, we've maintained a pretty darn strong public school system. And that's because of the emphasis of the parents and rural areas where they don't have private school alternatives and where school choice is more of a theory than a practicality. But I would argue we need to advance on every single front in terms of primary and secondary education for our children. Our public school system needs to be in the top 5, if not number 1, in terms of large states, and we need to enhance and increase our number of charter schools out there. And we need to give more school choice to our parents, to where they're not locked in where they are, but not at the expense of harming our public school system. So if we're going to have a bright future for our children and grandchildren in this state, we have to educate the generations to come better than we have ever before, especially Hispanic Texans, because that's going to be the majority ethnicity in our state for the foreseeable future, for the rest of our lifetimes for sure. And if you don't educate our Hispanic Texans to the level they should be educated, and if you don't find them productive jobs so they can support a family, I don't care how many people want to move here. Our future is not bright. So that's a really key thing to do. And I feel like there's been a lot of platitudes about it and not a sense of urgency. And I think right now is the perfect time to have a significant sense of urgency as this new generation moves to the forefront, especially as our young Hispanic Texans move through our educational system and then need to get jobs in the next 10 to 20 years. It's going to be critical to address that with excellence. And yes, we need to allocate more spending, but I think that's only one factor. I think there's a lot of factors in terms of producing the kind of outcomes we deserve in our state, both at the primary level, the secondary level, and the university level. So thanks for a good question.